Pop YouTube, welcome to another video, and today I'm going to be breaking down my entry criteria, what I look for when I'm trading, basically the very simple entry steps that I use to make $10,000 in 10 days using prop firms. And I will show y'all the payout proof via my Wise account. I'll show y'all the withdrawals that I received from TopStep in 10 days. So the first one, my transactions right quick. So TopStep Trader on the 6th of the month. Just blocking out my bank stuff. On the 6th of the month, you can see let me turn the brightness down. Sent me $4,330. So it's a little bit below $10,000. I was capping in the title just for the sake of the video, for the sake of the views that it would get, the clicks. My apologies, but that's the first transaction received on the 6th, and then here's the second transaction received on the 13th of the month. I can see right there, $5,000. TopStep LLC, just under 10K, in a span of 10 days, a little bit under 10 days. But yeah, break it down. What I look for, what I go through in the markets every day, and it is honestly very simple. Probably a lot more simple than you think. So yeah. First, what I want to preface in this video is if you do not understand anything that I'm talking about, any of the terminologies that I use, definitely do your homework, do your research, and come back to this video because it will make it a lot easier to understand what I'm saying. I'm not going to be breaking down each thing step by step, but I am going to give you a broad understanding and a broad just combined, breakdown of everything. So yeah, first of all, the markets move based off of liquidity. We're either hunting, generating, rebalancing, or I think it's one more: hunting, generating, rebalancing, or manipulating. So yeah, liquidity is unfilled orders left at highs and lows. This would be considered liquidity right here, since it is equal stacked highs. That is a strong draw in liquidity, strong form of liquidity. There's liquidity here. There would be considered liquidity left here. Any unfilled, high or low that has not been tapped yet, that would be considered liquidity, resting liquidity. Now, my step one would be this is just a buy example. It could be the same for buy side or sell side. It is, price is fractal. Price moves the same way. We can only go one of two ways, up or down, and it moves based off of these concepts. So I'm trying to break it down as simple as possible. So yeah, number one, I look for a clear higher time frame draw in liquidity. Some examples of strong and clear draws in liquidity would be a session wick high or low, which for example would look something like this. Let's just say from today right quick. I'll show y'all. So let's just say right here going into this day, you see we have London low stacked with Asia low. That would be considered a strong draw in liquidity because this is the draws that were left from Asia and London session the previous day. Usually have a very high probability to get hit. So that's just an example. But yeah, session higher lows, previous day higher low. You look at the daily chart, you see each day leaves behind wicks. Those are usually strong draws in liquidity as well. A data wick higher low from any news event, usually from red folder news. You will see, price in the market will be impacted very heavily. We'll have a very strong wick in, either buy or sell side direction. And that will usually, most of the time leave a very large wick. And those wicks can be very strong magnets for price. I like to look at liquidity and draws in liquidity as a magnet for price, in a sense. These are very strong magnets. Price is likely to go towards them and hunt them. That's another one. Equal highs or lows, like what I provided in this example right here. Whenever you have stacked highs right here that aren't, that one didn't take the other one out, that is another form. And then we have high resistance liquidity runs and low resistance liquidity runs. These would be, for example, a low resistance liquidity run is this. A lot of stacked highs or stacked lows in one direction that aren't sweeping each other. You have them stacked like this. None of them are taking each other out. It is generating buy side liquidity to be taken later on. And honestly, a perfect example is I will show y'all from the market. I want to say from today actually. I'll show y'all. But yeah, so after we get the higher time frame drawing liquidity, um, understood. This can also be on any time frame as well. Price is fractal. Price moves the same on the monthly, the yearly, the daily, the weekly, the 4 hour, the 5 minute, the 15 minute, the 15 second. It's all the same candles, same movement. Just depends on whatever you're comfortable with. I personally, usually when I'm going into a day, I will start off with the daily time frame, go down to the 4 hour, go to the 2 hour, maybe the 1 hour from there. The 2 hour I'll only go back to if the 1 hour doesn't really look the best. But usually from the 4 hour to the 1 hour, from there, 30 minute to the 15 minute. From the 15 minute, that's where I kind of sit at. The 15 and the 5 minute, I kind of sit there to gauge my trade that I'm looking for, or where I look and search my entries at, usually based off the 15 or the 5 minute. But all of these stacked time frames is where I kind of conceptualize and determine my bias for the day and what I want to see going into the morning. So let's say the daily time frame looks more bullish. We have a stronger candle on the daily chart, but then the 15 minute is bearish. I will usually 9 times out of 10 trade based off the internal time frame, but if it doesn't align with the external, I will just lower my risk. Simple as that. It's easier and it's a lot better when things line up, when the higher time frame aligns with the internal, but sometimes that won't always happen. You have to be able to mitigate your risk. You have to be smart with it. So yes, higher time frame drawing liquidity, I usually base off the hourly, 4 hour, 15 minute, daily, things like that. I then zoom into the 5 minute. I wait for the 5 minute to tap some type of higher time frame PD array, which can be a fair value gap, a balanced price range, or an order block. A balanced price range is where you have two overlapping fair value gaps, which is usually a very strong, kind of like a trampoline for price in a sense. Price will usually bounce out of these areas very strongly, very quickly, very fast. So that's what a BPR is. Then order block, I have been starting to use them more often. I have been seeing them working a lot more recently. I never really used them before, but I have been seeing order blocks and breakers working recently, so I have been incorporating them more. But probably 80% of my trades are based off of fair value gap. 80 to 90%. If it's not a fair value gap or the BPR, because those are kind of like the same thing in a sense, it'll be the order block, but I've been working to get it in more. From there, I look for internal manipulation, which can be considered as a, say I'm on the 15 minute, say we type a 15 minute fair value gap. I wait for the 1 minute to form an internal fair value gap. I'll zoom in, wait for a 1 minute imbalance to be formed, wait for an internal sweep in liquidity, which can also be considered a turtle soup in a way, depending on how you look at it. Turtle soup is basically just where price takes out a form of buy or sell side and has a very strong reaction in the opposite direction. Excuse me. Usually we won't revisit that high after that, and price will move very fast from that as well. But yeah, I wait for internal manipulation. Then my entry criteria would be a change in the state or an inversion for value gap. Oh wait, SMT, miss SMT for number 3, manipulation. SMT as well. This isn't required all the time, but I will break it down. I will and speak about it. Not all my trades are based off an SMT, but it is a very good confluence to have. So yeah, and then change in the state, inversion for value gap, or I wait for a pullback. A change in the state is basically where, say we have price trading down, then you have a bullish candle closed above the previous bearish one, indicating a reversal model potentially at the works. And then when you pair that with an inversion fair value gap forming a balanced price range, this is usually a very good area, a very good sign that price is going to reverse, and this is where I usually take my models from. So in this example right here, let's just pretend that this is a 5 minute chart. We have a 5 minute imbalance here. Price action has been, just printing. We put out equal highs, start to sell off, rebalancing into OTE of this range right here. This is another very important thing. Price is rebalancing always. There's never a time where price, like if you have an A plus setup but it's not in premium or discount, 9 times out of 10 it won't work. Price is always going to hunt premium and discount before any type of strong move. You can go back, you can back test it. Price has to be balanced in order to move fast and swiftly. So actually one more thing too I want to talk about. I'm gonna add one more. Time is very important. My entry model usually presents itself anywhere from, I like to trade from 9:38, usually a couple minutes after that first 5 minute candle was printed. So from 9:38 to 10 a.m. 10:05. That is usually where I am taking entries at. That is where my model is most present and where I'm taking the most setups. I don't like to trade outside of that. That is my window. That is my pocket. That's what's been working for me. That is where I am the most profitable. Time has to align as well. And that is also why sometimes your setups may not work if it's not the right time. I will get into that later. But yeah, so let's just say this is a 5-minute chart. We're printing, generating buy side here, left equal highs. Let's even say, for example, that this is a London session high. London session equal highs up here. We tap the 5-minute. From here, I would then zoom into the 15-second chart. I will see price printing. We're still selling off, and then boom, we get this change in the state right here, meaning the bearish trend has stopped. We have an indication that price is breaking the trend in the most simple terms possible. Price is breaking the trend. Is a break of structure, whatever you want to call it. We're not bearish anymore because we have closed above the previous bearish candle. From here, I will either instantly enter, especially if we pair that with an imbalance. Let's say right here, this is an inversion for a value gap. I'll enter on the body close of the change in the state, stop beneath the inversion, targeting those equal highs. Very, very high percentage win rate. You can go back, you can back test it, find it in the charts. It does work. Very, very high rate model. Now, sometimes where this model won't be as effective is if you get an inversion for a value gap without the change in the state. Now, when I get an instance like this, which would look something like this, let's just say, for example, let's say we didn't get any type of change in the state. We got an inversion. Trying to make it look like that, maybe. Bear with me. This is an entry I would still take. An inversion fair value gap out, coming out of a higher time frame imbalance internally is still a good model. However, it doesn't have as high of an effectiveness versus when you pair it with the change in the statement. Usually, my most profitable trades are when these two are paired together. But I do still take trades when one is, present and the other one isn't. I just mitigate the risk properly. I will take this with lower size versus the trade prior where we had the change in the state pair with it. This I will take with full size. This I will take with either a quarter size or half of my usual position just to manage my risk properly because I know that the odds aren't as in my favor as they would be if we would have paired it with the change in the state. Now another model you can take is just a straight change in the state. If we don't have an inversion for a value gap, I would also say to mitigate the risk, I don't trade full size if it's not perfect. The trade has to look perfect. The entry model has to look perfect. And don't be scared. Don't think that this isn't going to happen often. This happens daily, if not daily, multiple times a week, at least 3 to 4 times a week, easily. You will find this setup present itself a lot. And if you do it correctly, if you analyze it properly, you will make a lot of money with it. So yeah, that is essentially the trade and my entry model. And now how I manage my trade as price continues to roll out. Let's just say there's an imbalance right here, and this imbalance is lying in equilibrium of the range. Once we tap into this consequent encroachment of this imbalance, which would be these dotted lines right here, this is where I move my stop to break even, because from here we will either respect this imbalance and reject, come back and stop me out, continue in the downtrend, or we will run this imbalance with a lot of volume very swiftly and continue on. One of two things will happen, especially if the timing is right. If the macro is about to open up, if the 9:45 candle has just closed, that is a strong indication or a strong implication that price will speed up in volatility. We will get that move in whatever way price wants to go. It will make that move and it will be fast. And I will also break this down a little bit more in depth later on. So once we tap that imbalance, why did I just delete that? Once we tap the imbalance, I move my stop to break even. Now say we get a body close above it, I will now pyramid into this trade. I will take it with more size. I will, let's just say, double down on my position. Since my stop is at break even, my fill will get adjusted to here. New stop can still be break even because it is beneath this imbalance and price should not come back below this imbalance. So now let's just say this is even my fill. Stop is right here. Your risk to reward is quadruple. Now this is just an example. This obviously isn't exactly how it would be, but this is what I'd like to do a lot of the times to get the highest risk to reward trades, to keep my winners a lot larger than my losers. Now, this does also come with a lot of risk as well. You have to be mindful on where you are pyramiding at. I do it a lot. I've been doing it for a long time now. I do understand when and when I should not pyramid. I don't recommend it for any beginners. It's just something that I do. I'm giving y'all everything that I do. It's part of my process, part of my game plan. It's in my playbook. I would not recommend it for anybody that is just starting out. You should definitely just leave your trade. Once you enter, leave it alone. Let it run, do its thing. But once you do gain some experience, you get that intuition, you will get more time in the market. You can start to try to pyramid and play with that and experiment with it. So yeah, say we get that body close above now, I will move my stop, pyramid, move my stop to break even, whatever the case may be. And then I will also just let the trade run. If I get another chance to pyramid, I have trades where I can pyramid multiple times. There's times where I can, pyramid 4 or 5 times and when I'm out. It's all just, depends on the setup. It depends on the trade that I take and what is given to me. That is essentially that. It is the same on every time frame. This example, I said 5 minute into the 15 second. Now you can also do it based off of the hourly to the 5 minute, the 4 hour to the 15 minute, the 15 minute to the 1 minute. All of these time frames are aligned. You have to understand time frame alignment. It's all aligned, and if you're just patient and you wait for that, you will make money. You don't have to aim for the biggest risk reward trades. You don't have to, try to hit home runs every day, especially when you're just starting out. Let the market do its thing. Trust your model. Trust yourself. Be patient. Be disciplined. It will come. You will make money. As simple as that. The times where people, follow these rules and they don't make money is when they get in their own way. You have to get out your own way. Trust the system. Trust that over an extended period of time, if you take this exact setup, the market will reward you. You might lose a couple times, but over an extended period of time, you will be rewarded. Now, let's pretend that there's an SMT involved now as well. Let's just say right here, an SMT is when, because I trade the NASDAQ and the ES. They're both correlated pairs. An SMT is when, let's just say, for example, I'll draw an SMT for y'all. An SMT is when one of the pairs makes a higher high or a higher low, and the other one makes a lower high or a lower low. So now let's just say that's ES, and let's say this is NQ. Now the SMT would be right here, because as you can see, ES made a higher high, NQ made a lower high. This is a very strong indication of manipulation and potential reversal. Now, especially once you pair that with the, change in the state, fair value gap being tapped, inversion, whatever the case may be, this is a top quality A plus setup that has a very, very, very high hit rate. It does not occur as often. It might occur. I might see these once or twice a week, maybe. Just depending on the time frame that you're looking at when you're trying to take it on. The highest quality trades you want to really base off of the 5 to 15 minute. You don't really want to be sitting on the 1 minute too much. Only when you're zooming in after having a higher time frame, P/E be respected or P/E be tapped. You don't want to just sit on the 1 minute. You don't want to just sit on the 15 and 30 second. I would not recommend it, because you will see it more, but it won't be in as high of a quality. You want to take your trades based off the quality. This is one of the highest quality entry models right here. You have an SMT paired with a change in the state, inversion fair value gap gets tapped. You will sell off, and you will sell off very fast from here. Now, the same thing is for bullish structure. If you are bullish and I was drawing that wrong. My fault. Let's say you're bearish. How am I supposed to draw this? Hold up, my brain, my fault. Say you're bearish, and then you get this. Here we go. Did I even draw that right? Y'all get the point. When one makes a higher low and the other one makes a lower high, they're correlated. Yeah, here we go. You see right here, these two highs, which are the same. One makes a high, one makes a lower one. Since these pairs are supposed to trade in correlation, whenever one has a crack in correlation, that's a strong indication of manipulation, a strong indication of a potential reversal coming, and a strong indication of a lot of volume or a lot of speed getting ready to come in through the candles. When I spoke about time earlier, You can have the best setup possible, but if it's not the right time, it won't work. Like I said before, I have my time pockets, my time windows. I like to trade in the macros from 9:38 usually when I take my earliest entries to 10:10 the latest. If I don't find an entry after that, I will get off the charts. Especially recently, I have been finding a lot more times I stay on the charts, I do tend to lose more. The longer I stay on, I will maybe say be break even, or I might be in small profit. But if I do stay on after 10:10, a lot of times my win rate goes down, my mental capacity goes down, I get drained a lot easier. I'm not as focused versus within that first 30 to 45 minutes of the market. So I like to be on within those times. That is when the most expected volume is to be present in the market as well. You will see the most speed at the macro times, and when there's a quality setup. When it is a quality setup, you will see the most speed. You will see, the most efficiency within the market. And yeah, so right now, let me just go back and look for what I was talking about today, right quick. Um, so boom, this was a perfect example of a low resistance liquidity run that was taken today. Let's go right here to the 1 minute. I'll show y'all. You see all these lows right here. Price didn't tap any of these. All of these are just stacked. We're just continuing to trend up, generate more sell side. Now right here, I actually did take this trade. This was a loss that I took. I got stopped out. My stop was too tight. I had my stop right here, but if my stop was at this high, I would have never been stopped out. But as you can see, so let's say for example like this, low resistance liquidity, imbalance gets respected. We form an imbalance through that. This is where I would then, let's say, double down. I usually wouldn't double down for sale. I'll maybe add 7 and 5 contracts. I might add 3 more. I'll scale into my position, and now I'll move my stop to this imbalance high, because now you see I'm risking the same amount, give or take an extra, $20,000. This is paper trading, by the way. Giving an extra $20,000, but my reward is now multiplied 1 to 4, whatever the case may be. Once I get more conviction, more confirmation within my setup. But yeah, took this. You see, news came, swiped out all of this low resistance liquidity. Now, when we get an instance like this, now we form an imbalance, we respect it. I would then move my stop to break even. Simple as that. You see, we swept sell side, we swept buy side. We had an imbalance here that swept it as well. It got ran through. Had the change in the state as well, right here. Closed through it. Paired with the inversion fair value gap. I don't remember if we had an SMT or not. I don't think we did. I could be wrong, but had this low resistance liquidity run. Very simple model. It happens every day. It's how the markets move. Literally, you can get rich off of that. Hope y'all enjoyed this video. I try to keep it as fast and as simple as possible. Please give me any feedback. Let me know if y'all would like me to explain anything more in depth. I'm not really planning on doing like an actual step-by-step how to really trade type of series, because there's literally thousands of videos on this exact concept that I'm breaking down for you. There's thousands of videos of people that break it down that I feel like I would just be wasting my time. I can give y'all other type of value that isn't as frequent, that isn't as, common. That's what I'm here for. So yeah, I hope y'all enjoyed this video. I hope y'all learned something. Please leave a like, comment, and subscribe. Leave the feedback down below. I appreciate you for watching. Thank you so much. I'll catch y'all in the next one. Peace.